What's up guys, my name is Nick and welcome to my channel. In this video I'm breaking down the basics of covered calls. Now for many stock traders this is their first introduction to options and options trading, and honestly I do think it's a great place to start. The video touches on the concepts of intrinsic and extrinsic value of an option, and if these aren't familiar to you, you should check out this video first. Okay, I'll stick a link somewhere up there. Okay, before we get into the content though, do me a huge favour, smash the like button, subscribe to the channel, turn on notifications, it helps me out a ton. With that said, enjoy the video guys, I'll catch you at the end, cheers. Let's suppose you're long 100 shares of Apple stock. At the time I'm creating this video, Apple's trading at around $450 a share. The stock has had a huge run up in price since the lows we saw in the broader market in March of 2020, and it's now currently close to an all-time high. While you certainly don't want to sell your stock right now, maybe you feel the price may take a little bit of a breather and consolidate around these levels in the short term. Consider the following strategy then to earn additional income and reduce the average cost of your long stock holding. The September 25th $500 strike call with 45 days until expiration is currently trading at $8.60 an option. As this call is above the current stock price, it is out of the money and contains only time or extrinsic value. It would be worthless if the option were to expire right now. If we sell this call option then, we would receive $860 per option as the call writer or the seller. Remember, a single stock option controls 100 shares of stock. In return for this premium though, you assume the obligation to sell your shares for $500 in the event the stock is trading above the strike price by the expiration date. Let's look at two possible outcomes when the option expires in 45 days. If Apple is trading below $500 a share, the buyer of your call will not exercise their option to buy the stock. It just makes no sense to do so since they can buy shares in the open market at a lower, more favourable price. In this case, the option simply expires worthless and you get to keep both the 100 shares of Apple stock, but additionally the $860 premium per contract from the call sale. This reduces the average price at which you purchase your Apple shares by this $8.60. This is known as cost basis reduction. The process of writing calls on stocks you own can be repeated month after month, cycle after cycle, in order to continue to reduce the basis of your holdings, the ultimate objective being to lower the cost of the stock you own to zero and effectively create a free trade. I mean, don't laugh, it can take a while of course, but it is possible, I assure you. On the other hand, if Apple is trading above $500 a share at expiration, then your stock will be called away and you'll be obligated to sell them to the call buyer. Note that the net cost at which you sell the shares though is not $500, but rather $508.60, since the premium for the call option sale is yours to keep regardless. Okay, so our total return over the 45-day period is composed of the $50 appreciation in the stock price plus the $8.60 from the sale of the call option for a net return of $58.60. Okay, that equates to a 45-day return on investment of 11.72%, or an annualized return of just over 95%. Hang on a minute though, this sounds too good to be true. It's a win-win situation. Well, kind of, yes and no. If you're currently experiencing a sense of deja vu, do not adjust your screens. It's possible you may have seen my last video on cash secure puts. If you haven't, I'll drop a link somewhere up here. Look, the risks associated with holding covered calls and cash secure puts are identical. The only difference from a practical trading perspective is the way in which your broker will margin each position. Okay, let's get back in there. There are two risks associated with the trade. Take a look at the following chart. It compares the payoff from a covered call, denoted by the blue line, and a long stop position, the orange line, at the expiration date of the call option. First, note that the risk to the downside is not unlimited, but it is substantial. If the stock price goes to zero, losses will be similar to those of an outright long stock position. The premium of $8.60 that you received only provides a small reduction to these losses. Secondly, there is a potential opportunity cost. If Apple does rally very aggressively, while the covered call trade makes a very respectable profit of course, those gains are capped above the strike at which you sold the call option. It may have been more effective and profitable to simply buy the stock outright to fully participate in the rally. The selection of a strike at which to sell a call should reflect how bullish you are over the upcoming option cycle. There's a trade-off between the premium you can earn from selling the call option versus the upside potential from the appreciation in the underlying stock price. Let's take a look at three different choices with Apple trading at $450 a share. The following option prices are available on 3 different strikes, and I've also included the delta for each option. An at-the-money option enjoys the highest rate of time or theta decay. Note that in the example above, if all the options were to expire right now, the $450 and the $500 call option would both be worthless. Neither of those options have any intrinsic value. However, the $450 call has some $15.70 more extrinsic or time value than the 500 strike. Since both these options are composed entirely of time value, this is simply the difference in the premiums of the 2 options. A call option's delta is an approximate probability that the option will be in the money at expiration and therefore exercised. An at-the-money option, for example, has around a 50% probability of being in the money at expiration. Note the $400 call option in the example has approximately an 82% chance of being exercised and the long stock position being called away. This begs the question then, should you ever consider selling in the money call options as part of a covered call strategy? This implies being obligated to sell a stock below the current market value. Of course, you need to consider the intrinsic value in the option which compensates for this. The $400 call then has $50 of intrinsic value already baked into its price. Should a stock fall, not only does the time component of the call option deplete, but also its intrinsic value falls. As the stock moves lower in price then, an in-the-money option provides additional downside protection because of this intrinsic value. There's a trade-off though. Selling an in-the-money call option is a more defensive strategy that doesn't allow for any appreciation in the stock's price. The risk of assignment and having to sell your stock though, of course, is also higher. Okay, so in summary then, selling a call option against a stock that you already own creates a covered call position. You receive a premium for doing so, but in return are obligated to sell the stock at the strike price if the stock trades above the strike by the call expiration date. Premium income can be earned in exchange for giving up any upside above the written option strike, and this can be used to reduce the cost basis of the long stock holding. Strike selection allows an investor to trade off downside protection against potential upside profits. Thanks for watching, guys. If you made this far, you made it to end, and your support is very much appreciated. Thank you. If you have any questions in regard to covered calls or feedback in regard to the video generally, drop them in the comments section below. I answer them all personally, okay? If you enjoyed the video, be sure to smash the like button and subscribe to the channel. It helps me out a ton. Until the next one, guys, cheers. I forgot my drink.